Mm. Sahana, Ethan has to stop sharing before I can share.
Oh, yes.
Oh. Give me extra time to read something, change my background. Is my team ready? I hope y'all are ready. Okay, we can start. Sahana, I'll just start and then you'll start the timer, or do you need me to count down for you?
No, I can start the timer. You guys can get started.
Okay. Hi everyone, we are ASOF Consulting. We are team number 1 and our client company is Intel. And these are all consultants who've all worked really hard on this project, so huge shout out to them for that.
So here's a brief overview of what we plan to discuss today, focusing on Intel's main problems and our recommendations. So first, diving into Intel's current background. Their overall revenue has been up only 26% over the last 3 years, compared to their competitor AMD's 71% growth. Their gross profit margins have also decreased by 9%. Looking at the first quarters in 2020 and 2021, we see their net income decreased by 41%, their earnings per share decreased by 37%, and their operating margin decreased by 17%. So we've narrowed it down to 3 main problems that can explain why Intel is experiencing these 3 decreases. The first being a loss in market share. The second being the vulnerability of their software to cybersecurity risks. And lastly, we believe Intel is too heavily focused on one segment. Now, Kalsang and I will talk about Intel's first issue of a loss in market share.
Thanks, Diana. So we will focus on the CPU market first, where the 2 main competitors are AMD and ARM. With AMD, we will look at the direct CPU comparison, whereas with ARM, we'll focus on the CPU architecture. So a brief look at the current market options. We see the variety of chips that both AMD and Intel offer. Right now, AMD is dominating the budget-friendly laptop markets, but Intel is still dominant in the mid to high-end market. At a more in-depth CPU comparison, we see like AMD holds significant advantages in price, gaming performance, and CPU specifications, and Intel has advantages in overclocking and CPU drivers. Intel provides productivity and absolute performance, whereas AMD provides a better balance of price and performance. With Intel and ARM, they play to different strengths. We see that ARM is more power efficient and is designed for better battery life and energy efficiency, whereas Intel provides more power and speed. A potential problem is that NVIDIA might be acquiring ARM, which would pose a bigger threat in competition in regards of CPU and GPU, and we will talk about that problem in the future. And I'll pass it on to Diana for talking about companies DVD from Intel.
Yeah, so another factor of why Intel is losing market share is because large companies are making their own chips. Amazon started using its own processors, and their chips offer a 40% better price for performance than Intel's. Apple also announced that it was developing its own semiconductors, and its laptops would no longer use Intel processors. Microsoft is also designing its own ARM-based chips for its PCs and data centers, showing ARM's increased advantage in the market. We see that Intel is losing customers in markets that it has previously controlled. Companies want custom solutions, and Intel's current products cannot provide that. I'll pass it back to Kalsang to talk about our recommendations.
Yeah, so for our solutions, first, Intel should challenge AMD in the budget-friendly laptop market by lowering their chip prices and offering competitive prices. Second, Intel should invest in additional R&D with focusing on chip design and architecture. Last, they should push marketing for a specific niche of customers and companies with specific similar visions and goals, and target customers that value overclocking and performance boosts, such as gamers or video editors. And I will pass it on to Malika to talk about security flaws.
Thank you, Kalsang. Another one of Intel's bigger problems is its security issues. Intel software and CPU hardware is vulnerable to a multitude of cyber attacks. The major cyber attacks Intel is vulnerable to include Meltdown, Spectre, and Zombie Load. All three of these threats negatively impact Intel's programs by allowing access to the memory and sensitive data, and have posed as major problems for Intel CPUs and has played a part in the increased distrust among customers. Now we will dive right into our solutions. As for our first solution, we suggest that Intel partners with cybersecurity companies to address their CPU vulnerability concerns. One of these companies is CrowdStrike, which has been involved in investigations of several high-profile cyber attacks. Along with them, we have Cisco, which is already collaborating and making processors and can help Intel expand their partnership into security. And finally, we have Zscaler, a cloud-based information security company that recently extended their popular Zero Trust cloud security platform. In addition to collaborating with these partners, we suggest that Intel implements a security check-in program on all of their devices that routinely scans for potential threats and attacks. I'll now pass it on to Wendy.
Thank you, Malika. So besides those previous two solutions, we would also recommend establishing a loyalty program. Customers in this program will be able to get rewards, early or exclusive access to certain discounts, or maybe even trade in their old products for new products at a discount, and Intel would even be able to recycle those raw materials. Besides that, communication is a key factor in regaining consumer trust. One thing we recommend would be for Intel to divert more resources to their customer service, whether that's through the feedback on their website, their social media, or their call centers. And providing the best customer service possible is definitely a key here. Another thing would be transparency. Back in 2018, when there were the initial rumors of the Meltdown and Spectre security flaws, Intel's first response was an angry defensive blog post. That's not the way to go. So transparency is really key here. And in the future, if security problems arise and customers are already aware, Intel has to admit to it and apologize immediately rather than getting defensive. Next, I'll pass it on to Logan for the next section.
Thank you, Wendy. Our final core problem is the lack of overall balance between Intel's two segments, as they're too heavily focused on just one. So Intel's two overarching operating segment groups are data-centric and PC-centric business. Data-centric focuses on our data center group, Internet of Things, Mobileye, non-volatile memory solutions, and programmable solutions group, while PC-centric consists of our client computing group and is the largest business unit, comprised of 57% of total revenue. We want to highlight two segments in particular, the first being Mobileye, which currently represents the smallest percentage of total revenue. For a little background, Intel's Mobileye is arguably the global leader in autonomous driving and robotaxis. While other players in this market operate in small, unscalable geofenced areas, Mobileye does not have such constraints. Intel recently announced a deal with UDELV, and Mobileye's self-driving system will power the next generation autonomous transporters, with commercial operations beginning in 2023. Its deal with UDELV is non-exclusive, so Mobileye will take advantage of that opportunity to sell the same technology to its competitors. We expect Mobileye to connect with other companies creating taxi, shuttle, and long-haul trucking services, with some potential partners being Embark and Voyage. Over the last 5 years, a number of major self-driving companies or self-driving car companies have announced optimistic launch dates and failed to meet them. So if Intel can get their technology ready for market by 2023, it has the potential to become a major player in this emerging market. The second segment we want to focus on is the data center group, as data center sales fell 20% to 5.5 billion year to year, and cloud sales in particular were down 29%. External analysts are suggesting that cloud providers were reducing Intel orders as they simply began to reduce their own chips and produce them in-house. However, there is opportunity for significant growth. The data center market is projected to grow to 90 billion by 2024, and a potential partnership with Zscaler could help restore that dependence on Intel's chips and regain some of that lost market share. In terms of future projections, the client computing group we hope would go down to only 50% of future revenue and would be equally distributed to data center and Mobileye to give them appropriate portions of future percentage of revenue. And I'm just going to pass it on to Kelsey.
Thanks, Logan. So to summarize our solutions, Intel should lower prices for chips and target budget-friendly laptop markets. They should invest in R&D with chip architecture, form partnerships with cybersecurity companies, and connect with customers to incentivize and communicate, and expand focus segments with Mobileye and data-centric businesses. And I will pass it on to Diana to talk about our 5-year vision.
Thanks, Kelsang. So we forecasted Intel's 5-year growth, and our predictions show a 46% increase in net income and gross margin. We predicted this using a 10% revenue growth and 56% gross margin growth year over year based on Intel's previous growth rates in their financial statements. Now I'll pass it on to Malika.
Thanks, Diana. The first thing you'll notice is that increasing our customer retention rate and conversion rate will be constant goals throughout the years. Along with those two metrics, we also recommend one rotating goal each year. So in our first year, we hope that Intel will have partnered with 2 new cybersecurity companies. In year 2, we hope that Intel will see a decrease of 15% in any reports of technical issues. And in our third year, we're hoping for Intel to achieve the industry average net promoter score in that year. Intel's current score is 52, which isn't necessarily bad, but the current industry average for tech and hardware is 65. In our fourth year, Intel's marketing ROI should have increased by 3% from year 3. And finally, in year 5, we're hoping that Intel would have tripled the customer lifetime value from the current year. And now I'll pass it on to Wendy.
Yeah, so that's all for our presentation. We're confident the strategies we're outlining will definitely help attain the goals we just previously mentioned. And with that, thank you so much, and we're open to questions.
Thank you so much, Team 1. That was great. Now we have up to 7 minutes for judges asking questions.
Can you go to the first couple of slides where you had some numbers around the revenue and stuff which is going down? Just before the problem statement.
Before the problem statement?
Yeah.
Wendy, I think it's slide 6.
Yeah.
This one?
Yeah, this is good. This is
Okay.
good. Got it. Cool. I have a couple of questions. I hope it's okay. Firstly, guys, great work. I'm sure with all the things that you guys are doing, this is awesome that you're taking up such a problem and such a scaled problem and trying to break it down. Just a quick thing, like it seems like that operating margin is going down, net income is going down, and everything is going down. You guys focus towards the top line rather than the bottom line. Was there a reason that you did not look at the bottom line? And by bottom line, I mean the actual cost side of things rather than the revenue side of things.
Yeah, so when we were looking at their financial statements, we didn't notice a large variation in their costs. For the most part, year over year, their costs seem relatively similar. There wasn't a year that stuck out that was relatively concerning. So we decided to focus more on what we thought were the most prevalent.
And in terms of the R&D costs that are there, you guys were focusing on security as one of the challenges that you want to solve. Is there a reason that there was no mention of increasing the R&D budget rather than focusing on partnerships?
We did mention increasing R&D as one of our solutions to improve chip performance. Yeah.
Got it. Okay, sorry, I missed that.
No worries.
Just the last question is on the loyalty and communication front. This is a B2B company. So what kind of loyalty program do you envision here? And that too, this is not a front end provider. This is a back end, like a part of a machine kind of provider. So what kind of loyalty programs do you see here?
Oh, yeah, there are definitely loyalty programs in B2Bs, I believe. There's also like referral programs and such, but some rewards that they could get would just be easily extra little discounts on if they're like loyal customers. Like, let's say if they've made 10 purchases for the company from ours, and then we give them a certain percentage off the next purchase, if that would make sense. And then for trade-ins, that could also be because companies buy these products from us, like chips and whatnot, and then maybe they want to upgrade to our new chips, but they're like, what if we do these old ones? So one option for them would be to just bring in those old chips, we'll take them, we'll recycle the raw material, and then you get a discount off the next one. I feel like that would work for B2B, definitely.
I mean, most companies nowadays are doing these volume discounts, which is what the reward side of things that you were talking about. So something that Intel is not doing, or?
Yeah, not that it's not something that they're doing as far as we could see. So
Cool. I can, is that, okay. Moving on to another question. Can we go to the summarizing the solution slide? I think it was slide 24 near the end. So my question is, here you have 5 great solutions. By the way, great job. My question is, we're a big company and we can only do so many initiatives like at a time. So what's the priority here? What's like number one?
One thing would definitely be to form those partnerships with cybersecurity companies. As you can see, it ties into our 5-year vision where the goal in year number 1 was to partner with at least 2 cybersecurity companies, because we believe that tackling that problem at its root is really important. And then, so that would definitely be number 1, because we have to fix our problems before like expanding further. Does that answer your question?
Yeah. And just another second quick question. You know, there's a huge demand for like chips right now, and when you mentioned to like lower chip prices, I'm wondering if some of the effects like in marketing of Intel, would lower pricing sort of like change the perception of our brand, you know, to be like not as high end if we were to have lower prices than our competitors, perhaps, you know, versus like AMD, you know, they're charging all these premium prices for such a quality product. Do you think there might be any harm, and how can we mitigate that if we lower prices?
Yeah, so I think currently like Intel is still a brand name, you know, like when you get a laptop, most likely it'll have an Intel chip. The lowering prices aspect is just to like eat into like a more specific market too. Like if you look at budget friendly laptops from like $100 to like $400, there are both Intel and AMD options. So what we would essentially be doing is just like expanding a bit more, which we don't believe would harm our reputation or image.
Cool, thank you.
Thank you.
So I had a question as well. You showed Intel's decrease in revenue and everything. Can you speak to AMD, their competitors' increases in revenue, and what that has been like, and or their R&D budgets, and where that benchmarks with where Intel's R&D budgets has been?
Sorry, can you repeat the question, please?
So you mentioned Intel's revenues, which is great and all, but you're comparing them to AMD. So do you have any data points as to how their revenue has been in Q1 of 2020 and Q1 of 2021 and how it's changed? And specifically to their R&D budgets, which you're speaking to, saying Intel should increase R&D budgets. Can you speak to what AMD's R&D budget is like and how that has changed over the past 5-10 years?
Yeah, so when we were researching, we noticed that AMD's revenue has increased drastically, and we have also seen efforts for AMD to invest in R&D to increase their product performance, which is why we thought that we should do the same as well.
Okay, thank you.
Awesome. Thank you so much, Team 1. Thank you so much for presenting. That was great. Now we, Team 5, Quiznos, you guys can start sharing when you're ready.
Okay. Hi, we are Team 5, also known as the JCREC Consulting Group. We provide restaurant expertise and offer solutions to our valued clients. We're very happy to be here today to present to you our recommendations for our client company, Quiznos. This is my team, Jay, myself, Cindy, Rosie, who won't be here with us today, unfortunately, Ethan, and Jiping. Our plan for today is to firstly address the problem statement, the business model of our client, then our recommendations, and lastly, the future.
All right, so Alec, I have a question for you. Have you ever seen the movie Rocky?
I have a while ago.
All right, so many people share that same sentiment, and as you all know, Rocky is a tale about an underdog. And if we're being honest, everybody loves an underdog story. So after reaching $1.8 billion in annual revenue in 2007, our client has gone through rough times. And our aim here today is to kickstart the Quiznos underdog story.
Quiznos is a fast food restaurant that specializes in toasted submarine sandwiches. Their popularity has been declining throughout the decade. From 2007 to their 4,700 US locations have shrunk to less than 400, and the revenues have declined from 1.8 billion in 2007 to 171 million in 2017. In this competitive market, many customers have left for their competitors who have a bigger brand presence and more innovative sandwiches. In addition, Quiznos' current business model is not profitable or transparent to franchise owners. To solve their challenges, we recommend for our client to rebrand by innovating their menu and company image, as well as reducing their costs with a new business model. Ethan will now talk more about the problems our client needs to overcome.
Quiznos has three main problems: its strained relationship with its franchisees, a product with little differentiation ever since competitors adopted toasters, and a business model with low margins and profits due to high costs. Now I'll go over Quiznos' business model. A big issue for Quiznos is their franchise supply chain. Currently, Quiznos forces its franchisees to purchase their inventory and supplies from American food distributors, which sells at a 15% markup compared to market average. This markup exists because Quiznos receives a rebate from AFD. If Quiznos were to refuse this rebate and purchase supplies at the market averages, they could save approximately $38 million per year. Some of these savings would allow Quiznos to reduce its royalty fees from 7% to 5%, which would help repair its damaged franchisee relationship, while the rest of the money will be used for our other recommendations. Next, I have a revenue projection for Quiznos based on data forecasting a food industry average growth rate of 5% per year for the next 5 years. In 2025, we project a revenue of $43 million. Next is Jiping, who will explain some of the recommendations we have for our client.
These are the solutions we have for Quiznos to innovate: rebranding, a new marketing plan, menu, and a secret sauce. Our first step is rebranding the company's image. We propose a new modern logo to show Quiznos as the trendy and cool brand customers love them for. We'll partner with their most successful franchisees in the beginning to implement new store designs, fryers, grills, and drive-thrus. The store will encourage store group dining, and the grills and fryers will open up the menu to innovative offerings, allowing differentiation from competitors, as well as create an inviting to encourage customers to try these new offerings. We also propose an update to the website of Quiznos. Currently on the left, it's not easy to navigate and does not look appealing, but the new brand website on the right is easy to navigate, appeals to customers, and encourage them to order from Quiznos. Now I'll talk more about our marketing plan to increase Quiznos' social media presence. First, we'll have a rebranding showing the new Quiznos on YouTube. When Domino's was declining similarly to Quiznos and did a rebrand campaign highlighting their new store design and menu, they saw a 14% increase in revenue as a result. Next, TikTok, there's over 100 million monthly US active users, and it's a platform for Quiznos to connect with their target audience of 18 to 24-year-olds through viral content. We'll also utilize Twitter and have a hip and playful tone that will interact with customers and rival brands like Subway for raising brand awareness. Lastly, we'll have exclusive deals to encourage customers to new menu items and to come in stores or to order mobilely.
So now, Poe, I have a question for you. When you go to your favorite restaurant, would you say that you have a go-to meal that you eat?
I do.
All right, and so I feel like that a lot of people share the same sentiment. And with that in mind, we recommend that our client, they simplify their menu. So as our client revamps their brand identity, we recommend the menu be revamped as well. In the current state, the menu has over 20 different subs and over 100 different items across sides, desserts, soups, and more. We believe that this is too similar to their competitors in the market, and in order to pivot upon this, we advise for our client to adopt a more quality, concise menu that separates them from the pack while still remaining competitive. So in the future state, our client will offer a menu with emphasis on sandwiches with steak and chicken grilled in-house for the customer to see. This strategy will provide transparency gain customer trust, and give off a potent aroma that will entice passersby. And in a similar vein, specializing in grilled steak and chicken will cut our costs and supplies and create a quality gap between our client and our competitors. A key facet of our client's new brand is leveraging their popular peppercorn steak sauce. We believe that the sauce's popularity presents a unique opportunity to expand the Quiznos business model. This acquired brand, one second, I'm sorry. So we plan to partner with professional chefs and restaurant chains to create a versatile recipe that can hold its own at our partner steakhouse locations. And by partnering with these steakhouse chains, we will be provided with long-term guaranteed bulk orders of our sauce, exposure to more consumers, and subsequently increased brand power. This acquired brand power will influence more consumers to buy the sauce in stores. And with just a 5% market share, we can bring in $312 million in revenue annually to support the Quiznos recovery and establish a foundation for the future of the company. So our process looks something like our recipe will be created by in-house chefs and consultants, mixed and packaged by our supply chain partners, transported by our logistic partners to local restaurants and your local condiment aisle.
Now I'll talk about what the future will look like for Quiznos. Some of the immediate actions Quiznos needs to take are reducing their overall costs coming from their supplies and high royalty rates, improving their top selling products, and simplifying the menu. As mentioned earlier, decreasing the number of items on their menu is necessary in order to cut costs while making sure their most popular items consistently provide excellent taste and customer satisfaction. And lastly, Quiznos must enhance their franchisees' relationship. At the end of the day, franchisors and franchisees have one common goal, which is to grow a business that generates sustainable profits year after year. And the ways Quiznos can improve this relationship is by boosting franchisees' profitability with advertising and a franchise owner rebate program and such, as well as running an active discussion forum with their franchisor to better communicate their needs and challenges this point onward. Some long-term plans we have for Quiznos is that they will start a slow and gradual expansion of their stores as profits start to stabilize. They'll be initially opening/reopening more stores in the state of California and Colorado. Then they'll start looking into multi-state expansion throughout the nation. This is not something our client will be rushing, since growing too fast could bring potential harm, like potentially right-sizing infrastructure and outgrowing the capabilities of the resources. In addition, Quiznos will be adding some new additions, such as reconstructing existing stores, introducing fryers and drive-thrus by testing out the successful ones first, and lastly, targeting popular delivery apps like Uber Eats and Grubhub. The number you see on here is the estimated cost saved from cutting their supplies over 5 years. And here we have a brief breakdown of where the money will go towards. Approximately 50% would be used towards the infrastructure, such as adding drive-thrus, fryers, store renovation, and such. About 30 would go towards marketing, like rebranding the website, their app, and overall improving the reputation of Quiznos. And lastly, 20% towards the menu enhancements. Just to recap, here is what we came up for Quiznos' 5-year vision. The first 1 to 2 years, they'll mainly focus on cutting down costs, redefining the brand, and innovating the business model. Then the next 3 to 4 years will look something like implementing the fryers, grills, drive-thrus, and slowly recovering the revenue from the fixes from the previous years, and hopefully have that local expansion going. In 5+ years, we see that our client will hopefully reach multi-state expansion and expand their menu options as well. As we move to implement plans for a new, better Quiznos, we want to remind you all with a quote from Rocky. It's not about how hard you hit, but it's about how hard you can get hit and keep moving forward. That will be the end of our presentation. We are J-Craig Consulting, and we thank you for listening and would love to answer any questions you have.
Great, thank you, Team 5. The judges now have just 7 minutes to ask any questions.
This is Poe. I'll go first. This is an open-ended question. Can you pinpoint as to what was the downfall or the decline of Quiznos and where they started losing the market share and how their competitors were able to keep an edge early on and how we got to this place?
Yes, I can speak to this. There's a few main things that really hurt Quiznos during that time. The main thing is that their differentiation was in their toasters. And as you guys know now, Subway and any other, sub sandwich restaurant has toasters now. So their differentiation wasn't strong enough. Secondly, their issues with their franchisees led to many litigation and legal issues where there were hundreds of millions of dollars in payouts from class action lawsuits and things such as that. So that is why we put such an emphasis on franchisee relations.
In addition, they also had a very famous marketing campaign where the mask was this obscure looking rat, and it didn't create a very positive image for their company, and a lot of people associated with Quiz as being like a joke of a company and not very respectable.
Okay, yeah, thanks. That makes sense. And one more question regarding the $190 million you pointed out. I just wanted to ask for clarification. Was that savings that you were saying, or was that $190 million that you were budgeting, and then that was the breakdown that you were showing? Could you please go back to that slide? Yeah.
Yeah, the 190 million would be the amount of money saved per year times 5, and it's just sort of budgeting it towards each of our recommendations.
I see. Okay.
What was the revenue projection for 2025?
Oh, it was $43 million in 2025.
So just to make the numbers work, it's somewhere around, assuming 40 million. So for 5 years, they're about $200 million in revenue, approximately. And out of that, $190 million is savings.
I'm sorry, could you ask the question again?
So your revenue projection in millions is about approximately $40 million per year, let's say. So you're saying 5 years, they will basically make a total of $200 million. And in 5 years, they will also be able to save $190 million. Like they are basically losing more money right now than.
Yes, currently they are losing money.
50-60%, is that their net operating budgets? Like just to give you a sense, you're saying we will save $190 million and we will make $200 million. So if you have to save $190 million, or let's make it 200 just for ease of discussion, you're saying that they will have $40 million per annum of savings right now.
Yes.
Where will that saving come from if their revenue is also not $40 million? So they are basically losing equal amount of money that they are gaining. So 50% loss. Is that true?
The savings that we will get from stopping the receiving rebates from the supplier, because currently the 15% markup from franchisees to their suppliers, stopping accepting these rebates, we'll be able to save, get this savings in costs.
Yeah, I mean, like, okay, let me ask it a different way. What is their total cost right now? Annual total cost.
Just real quick, I wanted to interject. Something about Quiznos that actually kind of made this project a little bit rougher for us was that they went private around 2014, 2015. So we don't have access to their most accurate numbers. So we made predictions based on the past and things.
Makes sense. Makes sense. I mean, do you have a rough idea of their costs? Even in 2015 is good.
I don't think we have any.
Okay, no worries. But yeah, I mean, the main point was like, if $190 million is to be saved, it has to come from somewhere. If the total cost is $40 million and you're saying $40 million is what we'll save, you're basically saying we'll operate at zero cost.
And essentially right now we're operating like you mentioned before, we are operating at loss, and especially as we downsize and we've been bought out and things like that. A lot of capital from private entities and things like that have been coming in. So we have been running at the loss, trying to recover.
And by the way, just going back, like overall grade, this is awesome. Like I'm just trying to pick a bit of numbers there. And one more question from my end, if you don't mind. You talked about starting almost like a new business there, which is that whole, like the supply of the sauces and stuff. Is that the 1 to 2 year thing that you are looking at? Or I was not sure when you're saying that should be done.
In terms of the sauce, we're looking to get that done immediately. The sauce is already offered in the Quiznos stores. So what we want to do in the first couple of years is to reach out to these restaurant partners, work on a versatile recipe, and push that out through them.
We're also hoping that through the popularity of this sauce, that it will also increase Quiznos' brand awareness as well as be a source of revenue for them to cover and start a stronger foundation for the company.
I guess we have like a few more seconds. Could you just quickly summarize what your solution to the distributor was, just real quick?
It would be to renegotiate with either renegotiate with AFD and refuse the rebate in order to get a lower price, or go with another supplier.
Okay, cool. Thank you. Great job.
Thank you guys for asking all those great questions.
Awesome. Thank you, Team 5. Next, we have Team 8, GameStop, and you guys can start sharing screen when you're ready.
Are we all good to go? Hi, everyone. We are GameStop, and we are going to be presenting today. So my name is Chance. My team is Jacob, Garung, Saria, Megna, and Brittany.
After being on top of the gaming industry during the early 2000s, GameStop has fallen far in recent years. As physical games have dropped in popularity in favor of digital storefronts, so has the company's revenues and prospects. On top of these flaws in its business model, GameStop is infamous for its horrific customer service and poor employee culture. Sharply shifting GameStop's business model from outdated physical game sales towards gaming hardware and collectibles, reforming its insufficient customer service practices, and reutilizing storefront space will take the company a long way towards regaining the relevance it previously had.
We all know that GameStop for the past decade has not been performing well, and even though the stock is at all-time highs with a short squeeze, we do believe that with their current business model, they're going to continue to decline because of the decline of physical game sales. GameStop focuses on selling and reselling physical games. However, in 2018, only 17% of all video game sales were made physically, while all the others were made digitally. And also with the generation of the new consoles coming out with cheaper options for the consumers that do not require you to actually have a disk drive in it, you can't actually buy physical games anymore. And now one problem we do see with this is that the consumer's ability to get this hardware is near impossible. The PlayStations are all sold out. The GPUs, CPUs for computers are all sold out. And if you do want to buy one, you're going to have to pay double to near triple MSRP for your different computer components. And this is caused by botting. So a bot is a computer program that automates online tasks, such as purchasing highly demanded products from retail sites. So we saw a 788% increase in bot activity to retail sites in September and October 2020, which coincidentally is when the PlayStation 5 dropped. And if you did want to buy a PlayStation 5, on average, you're going to be paying about 160% of MSRP.
Another explanation for the hardware shortage we're currently seeing in gaming is caused by COVID-19, which has caused a global shortage in the semiconductor industry. As you can see, lead times in this industry have increased by an average of 10 weeks since the start of the pandemic. And since all the gaming consoles and computer parts use these, that has made it very difficult for consumers to get their hands on this product. So our overall solution is to shift GameStop away from physical game sales and towards hardware sales. GameStop can order hardware on the back end due to their access to manufacturers and producers that the average consumer does not have. And then physical sales of this hardware in brick and mortar GameStop stores can allow consumers to avoid botting and other issues that force them to pay double MSRP or not get these products at all. And sales of this highly demanded hardware will drive traffic to physical GameStop stores, which is perfect because we will also repurpose floor space to move away from physical games. We'll transition to having hardware in the back, and then in the actual storefront, we'll have collector's editions, antiques, and other things consumers cannot really replace online. And along with that, we'll utilize the rest of the space for gaming lounges and more interactive experiences that we'll talk about.
Let's talk about the customer service issues. GameStop has two major customer service issues where there's customer disconnect and unreasonable company goals. Your employees are forced to push power-up reward programs and trade in to customers, which makes the customers frustrated since employees keep pushing them even after they show no interest. There's pressure on the employees to keep on pushing about the power-up rewards to the customers, and there is a lot of pressure on the customers to get the power up even after they do not want it. So second of all, there'd be long wait times and lack of employees. Wait times often exceed an hour for customer support, which is not what it's supposed to be. There should be 10 to 15 minutes at the most where customer support reaches out to the customer. With that, there's bad technology where website issues doesn't allow for returns, causes delays and loss of orders, which is a great loss for GameStop.
So moving on to the solutions, we can start with reducing customer response time and increasing staffing. This means things such as updating the website to allow for online returns to decrease call center wait times and increasing holiday staffing and support. We also want to promote employee authenticity by integrating rewards programs that are less manipulative and pushy in certain ways. This means focusing on metric goals such as gaming lounge signups, physical merchandise, and hardware sales instead. Moving on, we can also increase morale and reduce pressure with team building activities and focusing on the metrics I mentioned earlier. Furthermore, we can increase opportunities to show skills since GameStop employees are passionate about video games and technology, and allowing them to showcase their passion makes the shopping experience better for customers and employees. And lastly, we want to increase cost effectiveness. Despite higher upfront training and organization costs, these reforms will save money and improve performance over time. We have $500 million in cash that we can dip into for our initial funding. We will have higher labor costs and costs of investment in hardware, but productivity and revenues will increase as well to improve employee performance.
Now, looking at the esports industry, there are increasing opportunities with the vast rise in audience engagement through various outlets such as live streaming and league tournaments being some of the biggest market drivers. The global esports market size was valued at $1.1 billion in 2019 and has been expected to grow at a compound annual growth rate of 24.4%. Moving on to the global gaming market, we will continue to see a growth in the following years, exceeding $200 billion by the end of 2023. In particular, the console gaming industry has been showing a 6.8% growth, being valued at $45.2 billion in 2020. And the PC gaming industry is growing at a 4.8%, being valued at $36.9 billion in 2020. Now, with vaccinations rolling out, we're on the path returning back to normalcy where we host large gatherings. And with the pandemic having shown a spike in the interest in gaming industry, we believe that GameStop's gaming lounges would provide a place for people to come and have fun while testing out and playing new consoles and games for a fee. Our gaming lounges would focus mainly on two sectors, the console gaming and the PC gaming. The gaming lounges will act as a major way to democratize technology, making it accessible for everyone. It also allows for the perfect social hub to meet like-minded people or perhaps even meet a future teammate for your next esports tournament. Finally, this space would also be used for events such as release parties, meet and greets, or party rentals where you could book the entire lounge for yourself.
Gamers Paradise, Tier 1 Gaming Lounge, and Gamers World Lounge are some prime examples of popular gaming lounges in the US. Due to their success in their cities, we propose for GameStop to base their gaming lounges off of theirs, as they offer over 45 gaming stations and 3,000 games in their lounges. However, they aren't exactly reputable nationwide, which allows the perfect opportunity for GameStop to enter the growing market and dominate as a big player due to their well-established reputation in distribution of stores. So with this subscription-based business model for gaming lounges and rentals, members can pay $20, $25, or $30 per month for varying amounts of hours to play in gaming lounges and rent products. Members also only pay $3 more for each additional hour of game time, as opposed to the $5 per hour that non-members have to pay in addition to tournament fees. This refocusing of GameStop's physical locations should be implemented within 1 to 2 years when select stores would be renovated into gaming lounges, which GameStop can fund with the $500 million of cash they have on hand. If this new business model succeeds, we propose for GameStop to invest in expanding the size of stores whose gaming lounges show the best performance. With more square footage, GameStop will be able to host bigger events, have more products available, and sell collectibles to encourage more consumers to visit the stores in the long run.
And then moving back on with the finances, we see with our forecasted net sales that after 2022, where we start implementing our 5-year plan, the products start going, we believe that we will easily start out competing our previous business model, which will be declining every other year due to the decline in physical game sales overall. So we're trying to pivot away from that, focus on revenue, gaining from those hardware sales, gaining from the revenue from those gaming lounge subscriptions in order to create a nice cash flow for GameStop. We do believe that our operating expenses will increase as we're trying to both renovate and facilitate these gaming lounges as well as acquire hardware. However, we do believe that our operating loss will actually decrease because of the increased revenue from hardware sales as opposed to physical game sales, as well as the gaming lounge subscriptions and money we get there, as well with the increased productivity from our employees. Thank you very much. We're open to questions.
Thank you, Team GameStop. Now we have 7 minutes for any questions.
Oh boy.
I can start off. Great presentation. Can we go back to the shift to hardware sales, the solution slide? I believe slide 11.
Yes.
And can you walk me through what that on the left, what was the focus of that again? Is that you're gonna, so I know there's a higher demand of these consoles, the actual consoles. Does GameStop currently sell those consoles?
So
in the store?
So yes, but so I remember distinctly when the PlayStation 5 came out, there were 4 PlayStation 5s in GameStop on launch day. So it is not their biggest emphasis. And so basically the idea is to secure better connections on the back end with the producers and with, Sony and Microsoft and the computer companies, the PC part companies, to enable us to have more access to these and then to pivot so that that's our main focus so that we can invest more in getting more product.
Cool. Yeah, you sort of answered the question I had. I was just thinking, like, I mean, GameStop can only control so much of it, right? Sony only produces so many PS5. So, yeah.
Oh, yeah.
I mean,
but we definitely think we can secure a larger part of that market. Also, GameStop sells a lot of these online right now, and their websites are suspect to the same issues that we've talked about with botting and basically being impossible for the average consumer to buy those. So by shifting all the product to brick and mortar, we can actually make that a much more robust kind of situation.
Cool. That's interesting though, because a botting sale is still a sale to GameStop, right? They still make the money off of it. So a sale is a sale, but there's the customer side to it too. I see. Cool. Thank you. I'll pass it on to my fellow judges.
Just a follow-up on this one. You're saying you move from the web-based sales to the brick and mortar sales. I'm assuming with the brick and mortar, given the costs go up, your essential price of the product itself will probably be a bit higher than your competitors, something like Target or something of that sort. So if you're selling PS5 in brick and mortar, your operating costs are higher.
Yes, but the price to consumer would be the same.
So you're basically operating on a narrower margin.
Yes, but I think there's a lot to say with the fact that we're basically the only proprietary location where normal consumers are getting this hardware when it comes to reputation and traffic.
So is there a reason why you don't improve your web portals itself rather than going to brick and mortar?
Frankly, I'm not sure anyone has come up with a fully robust solution to the web problem right now when it comes to giving average consumers a chance to actually buy these products. So that is kind of a short-term solution. Obviously, if the web purchasing experience becomes better in the near future, GameStop we talked about improving our technology and our website a little bit. We have those resources, we can utilize them, but in the short term, our brick and mortar stores are a good place to give, real people the chance to buy these, even if the margins are slightly worse.
We also believe that having the physical game sales, so consumers actually show up to the stores, may also entice them to participate in the gaming lounges to provide that extra revenue stream to also help with those margins as well. So it won't completely just be selling the hardware, because now you might be like, oh, let me try this game here for $5 or whatever for the non-member rate. You might like it, then you go purchase it later on your own console.
So speaking of the gaming lounges, can you speak more to the investment that's needed for these gaming lounges, what you're expecting the cost to be for the first couple of years, how you plan on rolling them out? Do you want them to be rolled out in every store right now, or do you have a plan as to what those stores are and why you're choosing those stores?
Yeah, so I'd say for the gaming lounges, we definitely want to focus on more of the higher density areas first, what we think could be some of the larger stores where we could have a larger gaming lounge. And with a couple of consoles, couple of PCs, we'd probably see an investment around maybe $5,000 to $1,000 for just the computers or the consoles, and then maybe monitors and everything, an extra couple hundred per console or computer that we have, as well as keyboards and mice. And we believe we can invest that with the $500 million we have in cash on hand, and we believe that will be able to help us get the pilot stores running. So maybe we can start getting revenue there to help facilitate some of the other stores, and if that's very successful, start rolling them out and maybe investing in even larger GameStop stores.
So to dig a little bit deeper, from that $500 million in cash, what's your upper limit that you're willing to spend on these gaming stores? Is it 50 million? Is it 100 million? Is it 250 million?
Because of our ability to start operating at a smaller operating loss, we probably want to stick around maybe 100 million within the first couple of years, especially because GameStop has 4,000 stores. So if we target some of the higher density ones, we believe that we can hit a good amount of those in order to start getting that revenue to maybe knock out that operating loss and start getting more cash to actually invest in our own activities.
And I'd also add that by limiting it to pilot programs at first, we can kind of focus our advertising to certain areas. So if we do advertise and kind of make a push to get people in these stores at first, along with the hardware aspect of getting people in these stores, we don't have to advertise in like every single place. We can kind of keep those costs lower.
Cool, thank you.
And just to clarify, that $500 million is the cash they have on their balance sheet?
Yes, yes, that's the cash they have on hand currently.
And do you guys have a breakout of like what their current revenue breaks down into in terms of like video games versus consoles or something of that sort?
For their net sales, which is predominantly focused on those physical game sales, it's about $5 billion annually. And that's been declining every year. Last year, it was 7 billion. The year before that, it was 9 billion. So it's falling very quickly. And we believe that if GameStop is aggressive and pivots their model, they can maybe prevent that further decline. Because currently, if they keep cutting costs rather than changing the business model, they're just going to die later.
Thank you, team.
Thank you all for your questions.
Thank you so much, teammate. So now we have an intermission for 30 minutes. Just a sec. Ethan, I think you can start sharing screen. So it's 10:01 right now. We will be back by 10:30. I will be opening breakout rooms. And so we have breakout rooms for judges and all the teams as well. And there's also like a general lounge or main room, so feel free to move in and out. Let me know if you guys are able to. Okay, so now we have the next round of presentations. The first one, Team 13, AMD. You guys can get started.
Good luck, everyone. Good job so far.
Can everybody see the screen?
Yep, you're good to go.
Okay, great. Today we'll be presenting our proposal for AMD. Thank you all for coming. This is our team. I'm Nathan.
I'm Arlene.
I'm Ela.
I'm Ryan.
I'm Amr.
Here is our agenda. I will first give a quick company overview, then I'll move on to stating the main problems AMD has. We will then transition over to discuss our three topics, which are data center market, GPU market and crypto mining, and financials. Lastly, I will complete our presentation by giving a brief summary of the topics that were covered and how they resolve the problems AMD has. AMD is a global semiconductor company that develops computer processors and related technologies. Some of its main competitors include Intel and NVIDIA. Currently, AMD has sufficient funds to cover their debts, but it is in their best interest to not spend all as they are merging. If we overextend the funds they have, they are more likely to incur more debt as they'd be expanding too quickly. AMD should not use most of their cash to cover their current liabilities. The other problem AMD is facing is a worldwide chip shortage. This is a problem for AMD because their GPUs utilize chips in order to function. The chip shortage is caused by two main factors, one being that COVID-19 disrupted the supply chain, and the other being the recent rise of cryptocurrencies. A large part of AMD's value is based on its ability to gain market share, and given its strong competitors, this can prove to be difficult.
The data center market is incredibly important for AMD. Recently, in order to build up its data center, AMD entered a merger with Xilinx. This relates directly to issues with debt and the chip shortage. But with a little bit of extra planning, it can prove to be extremely beneficial. Prematurely identifying potential customer losses and difficulties in keeping up with demand can prepare the company to mitigate future issues, particularly regarding supply chain management. While the merger is financed completely by stock, other costs will arise. Increasing short-term cost estimates makes it easier to reach revenue growth targets in the future. Conducting a company climate survey within one fiscal year can also help assess whether there are any glaring post-merger issues. Long-term, AMD needs to emphasize post-merger integration using feedback from its initial climate survey, and then needs to continually reevaluate the company climate for the next 2 years to ensure as smooth a transition as possible. Routinely comparing projections with actual outcomes allows for more accurate budgeting and identifies any problem areas. Using these comparisons, AMD can set detailed budgets on a quarterly basis, and given the nature of AMD's operations, regularly evaluating its individual segments will help efficiently allocate resources within the company and minimize strain on those resources. Looking forward, the data center market is one of great potential growth. From 2019 to 2020 alone, AMD's semi-custom segments revenue grew by over 64%. Its server chips tend to have a gross margin above the company-wide margin. Therefore, increasing its server chips point to an increased gross margin overall. The Xilinx acquisition gives AMD the opportunity to grow the size of its data center, allowing it to compete with Intel and giving it the opportunity to gain more market share. If implemented correctly, this merger could result in a long-term compound annual growth rate of roughly 20%, compared with approximately 10% currently, and we can conservatively project crossing $16 billion in sales revenue by 2022.
Moving along, we will be looking at the GPU market and why AMD should dive into cryptocurrency. Crypto miners are people who use graphic cards to verify blockchain transactions. This requires the miner to buy a lot of GPUs in the market, leaving other consumers empty-handed. While this is good because AMD's product will constantly be sold out, it is also bad because customers cannot get their hands on one. Two of the biggest GPU providers are AMD and NVIDIA. NVIDIA GPUs are more desired for crypto mining, but recently NVIDIA has announced that they are limiting the hash rates through software updates on their GPUs in order to cater to the audience that wants one for gaming. This is why I recommend AMD to create a department that would be crypto focused. With the recent rise of blockchain technology, they have a whole untapped market. Blockchain is a new generation of technology, and we have AMD become the face of blockchain. This could be a game changer. They could begin this by implementing a new product line that caters to blockchain-related technologies. And for the recent rise of crypto miners, they can create a product line that caters to mining. So how do we do this? I've created a 5-year roadmap for AMD in which they will begin by reformatting their GPUs to become more efficient and focus on blockchain technology. They will then design a product that caters to the crypto miners and scale accordingly. But is this option feasible? If AMD were to position themselves into cryptocurrency, they would dominate the new market and secure the market shares. The current market is profitable, with ASICs being the biggest player for crypto mining rigs. ASIC products are expensive and their products are locked into a specific coin, making them an unfeasible long-term solution for most consumers. There's a lot of room for AMD to grow with this new market. And with that being said, the cryptocurrency market size is expected to grow from 1.6 billion in 2021 to 2.2 billion by 2026 in the US alone. This is looking at a CAGR of 7.1%. Not only is transitioning into this new market a viable option, but it will put AMD ahead of all their competition.
All right, moving on to financials. I'll be giving out a general outlook, discussing some solutions, and providing some future outlook on it. With finances, we did receive lower credit ratings from credit bureaus such as Moody's and Standard & Poor's. They have been upgraded recently. Other than that, since we are doing a merger and we're trying to break into a whole new market, we do suggest that we might run into the risk of debt due to shortage of cash, since we might be expanding too quick. Something to be noted, AMD's quick ratio is a 1.94 versus the market median, which is a 1.82, which suggests that we are pretty liquid. We could cover our short-term debts pretty easily with what we have at hand. NVIDIA, on the other hand, our competition is sitting at a 3.63, which will be our other competition, which just tells that they're more liquid than us. So they are a little more flexible in that context. A couple of the solutions to help us out. First thing, we worked on raising the corporate credit score, but other than that, we might be looking to borrow a loan from JP Morgan, Goldman Sachs, Morgan Stanley, or other peer-to-peer. We're looking to get a loan in total of $1 billion to $1.5 billion. It could be either done, it's going to be a combination of asset-based loan and revolving loan based on liquidity needs. Right now, AMD's account receivable is about 2,066 million, and we could get a loan about 75% of it. And for our revolving credit line, we are sitting at about 160 million, which we could utilize. Since the merger is going to be entirely based off equity, but for to meet up the demanding costs for our expanding nature, we don't want to leverage more equity for cash, since AMD is a growing company with our earnings per share and value going up, and we just had a record year for revenue. Our equity is going to be more expensive for us to purchase back in the future. Looking at the outlook, our computing and graphics segment revenue is expected to increase approximately by 55 to 60% within the next couple of years, according to Sense analysis that we did. And our total sales revenue is estimated to reach 16.8 billion by 2022, versus what we estimated was 12.2 billion without the merger. So that's great for us. And moving on, I'll let Arlene take over.
To summarize our proposal, these are our topics and the main problems they each address. Overall, focusing on these three areas will directly help in reaching solutions to AMD's main problems. Securing an asset-based loan and a revolving loan will help build AMD's corporate credit score. The cash can be redistributed into the merger, the crypto line, and outsourcing production to third-party chip producers. Creating a crypto-focused product line and expanding into the data center market will give AMD the opportunity to branch out and gain market share in two key areas they are currently missing. Long-term, these combined solutions put AMD on track to combat its issues and thrive as a company. Thank you, and we are open to any questions.
Awesome, thank you so much. The judges now have 7 minutes to ask any questions.
So I'll start off, and some of these you may have answered, so I'm just going to re-ask. Number one, market share. You mentioned at the very beginning that one of the problems is that AMD is losing market share. Can you speak to what the market share currently is and where AMD sits in that market share versus the other competitors who have that market share?
Yeah, so AMD is actually doing pretty well in that they're gaining market share, but they're doing it at a relatively slow rate. And particularly regarding their data center segment, Intel currently has over 90% of the market share. And while AMD grew by about 3.8 percentage points since last year, with this merger, they have the potential to do much more. And it's a big revenue segment for them to earn on.
Okay, so the specific market share you're talking to is pointed at the data center market.
Yeah, there's also, if anyone else wants to jump in about the CPU, GPU market share.
Oh, yeah, I could give some details on that. So the CPU market share for AMD is sitting about 29% right now, and Intel sitting at 71%. GPU sector, AMD is sitting about 17, NVIDIA with 15%. But the thing is, AMD is growing since our sales for a lot of our consumer-based processors and our Radeon line is increasing. So it's just a matter of time that we're able to produce enough, sustain enough production that we could gain more market share since NVIDIA is struggling.
And then one more question regarding debt being the issue. Yeah, I think you talked about it a little bit in the financials. Could you go to that slide, please? What is the current debt that they have? And
all right. So that's not really an issue right now. It's just us avoiding future. I think our total liabilities were sitting at 2.86 billion, and with the quarterly debt last quarter we increased to 832 million. I think our debt ratio is about 5.66, which is pretty good. We do have more assets and accounts receivable what we could cover. It's just since we are expanding into a whole new territory, like a blue ocean that hasn't been explored with the merger, there's other underlying costs. So we're just trying to get ready for the expansion and plus breaking into new markets, since it'll be a lot of R&D and marketing once to release those products.
okay, okay, thank you.
Just a couple of quick follow-ups on those questions. One on the merger, you say that there is a huge potential. So what are the revenue growth strategies which are coming out as a result of the merger rather than individual companies?
Yeah, so the biggest issue right now, as far as AMD is concerned regarding its data center market, is that it simply doesn't have the size to maintain sustained growth. And Xilinx is sort of in a similar boat, except they focus on semi-custom, whereas AMD is a little more segmented. So with Xilinx's development strategies and with AMD's pure resources, they both have the opportunity to increase their growth in that specific segment overall.
So just so that I'm sure, what do you mean they don't have size? Like they are not able to produce enough products, or what?
Yeah, so that's pretty much it. It's that they don't have the capacity to be producing as much semi-custom, given their current level of CPU GPU production.
And Xilinx has that capacity, but they're not able to sell enough.
Yes. So Xilinx its entire focus is on semi-custom, and a big part of that is product development. So AMD doesn't focus on semi-custom product development as much, and given Xilinx's, I want to say, expertise, that's the word I'm looking for, their expertise regarding semi-custom, that sort of tied in along with AMD's resources gives them both the opportunity to grow.
And what are these resources that you're talking about?
So again, they've been growing for a pretty long time now, and they have a relatively good position in the market considering where they started out. And they have enough capital behind them that they are in a place where they are able to expand right now.
Okay, so just to reiterate the point, it's money that is bringing in by AMD, and then Xilinx is bringing in the product.
Yes.
Right. Okay. And the other thing, in terms of the debt part that was there, what's their debt to equity ratio right now?
I think the debt equity is sitting at 5.66. Yeah, last time we checked. So they're not in like current debt right now. They do have more assets to cover and cash at hand to cover, but it's just okay. Sorry.
Yeah, I mean, I'm sorry, I'm interrupting. Normally debts are good because debt is cheap, right?
Yeah,
so like I don't care if it's 5% or 40%. What I care is that it is appropriate for the business itself. So in that sense, is there debt to equity ratio, which 5 is super low to me, by the way. How is that as compared to like their peers in like Intel or Nvidia?
That's a good question. I actually do not have a comparison number to Intel and Nvidia regarding that, since we were more focused on our own segment regarding like our expansion.
Sounds good. Thank you.
Cool. And I know we have one more minute. I'll have one more question for you. Can we go to slide 15 with your 5-year vision? You know, the crypto market has changed so much in the past 5 years itself. Think about 2016 to 2021. So I'm wondering, you know, if you're going to build this crypto focused product line in the next if it's going to take 5 years, are there any considerations of how the crypto market will look in 5 years? Like, where do we get this 5-year timeline from? Will it take 5 years? Have competitors taken 5 years, etc.?
Yeah, so the crypto market is actually relatively new. It's like an emerging market, right? It's hard to gauge the exact number, but we're expecting a CAGR of 7.1% from 2021 to 2026, which is roughly 5 years. And not only is it 7.1%, but after that, it's predicted to increase with the ongoing years. So as of right now, there's no the biggest player is ASUS. So we do see ourselves becoming one of the biggest players considering AMD's revenue and there are the product lines currently. So yeah, we do see it as a viable option in the future.
Cool. Thank you.
I could add to that if you don't mind.
Yeah, go ahead.
Go ahead. Yeah.
Okay, perfect. The 5-year plan, since it's based on how much coin's gonna get mined in the future, so we're really relying on the value of what the market value is for the stuff. But we're selling hardware to these bigger mining companies. So at the moment, our cards will do just fine. The main issue that we're trying to deal with is decrease the amount of electricity those cards take and work on the hash rate, how can we make the hash rate more efficient, while our GPUs right now are more focused on rendering frames and using other technology to help people game. So that way we're able to segment out the market. And since ASIC is limited to one coin, well, with my GPU, I can mine Litecoin, Bitcoin, whatever. So it's more flexible option for others, and it's cheaper hardware as well. So that gives us a certain advantage over ASICs, and we should be able to grab a lot of market share once we do focus down, increase our production numbers.
Cool. Thank you so much.
Thank you.
Great. Thank you, Team 13. Next up, we have Team 4, Panorama Music. You guys can start sharing when you're ready.
Before we start sharing, I have a small request. If you have Zoom on the standard view setting, if you could move all the speakers on the top bar instead of having them on your right, that's our recommendation. Definitely not a requirement for the presentation, but that's what we recommend. Yeah, thank you.
Pandora Music, a popular music streaming app, has experienced declining revenue and profit. In order to help fix this, they tried to merge with SiriusXM. However, this was just unsuccessful. And this is why Pandora is in desperate need for BCG, Best Consulting Group. Now it's time to meet the team.
Hi, I'm Anvi.
Sorry, I was muted. I'm Jennifer.
I'm Jenny.
I'm Aoife.
I'm Keisha.
And I'm Andy.
So what happened to this music streaming pioneer? Pandora is nationally recognized by US adults and teens, yet they are struggling to increase paid user, the issue that threatened the revenue generated from subscription. And Pandora's user base projected to decline by 2 to 3 million per year from now on, while Spotify expected to welcome 20 million more users to that platform by 2023. That being said, Pandora's would need to improve their strategy regarding user experience and exclusive feature to encourage people to switch and acquire free roamers.
This is our agenda for today's presentation. We will provide you all with context and rationale by going over background and user research, consumer breakdown, and primary concerns. Our recommendations will touch base on redesigning, content and quality, marketing strategies, streams of revenue, and then finally, we will present you all with our 5-year vision for Pandora Music. Let's take a look at some groundbreaking statistics by taking a peek into the current music streaming industry scenario. As you can see, our client, Pandora Music, is all the way at the bottom with a market share of only 2%, and BCG will help them change that.
We distributed an extensive survey and received over 100 responses. Around 90% of the respondents were of age 18 to 24, which will be our target audience. We evaluated music streaming preferences, and the top 3 features that users found most important were music selection, audio quality, and playlist making. We took this into account when developing our evidence-based recommendations. So in the survey, we asked, why don't you use Pandora Music? The most popular responses were that they prefer Spotify or other platforms, they've never heard of it, they dislike the radio and lack of playlist making, or that they dislike the poor design. To look into user preferences in terms of branding, the easiest way to do this was to compare their past app logos, which portray very different branding approaches. 74% preferred the colorful, brighter logo. We use this data when constructing our marketing strategy with targeting toward Gen Z and building out a more consistent, memorable brand.
In the past 5 years, Pandora has been a dominant music streaming platform in the US market. However, Spotify will surpass Pandora in the number of listeners starting from 2021. The shift in consumer demographic could be the cause of the decline. Based on our research, we believe that Pandora is favored toward older generation, around 50% age between 25 and 44, whereas Spotify is more popular among tech-savvy millennials and Gen Z. They represent around $350 billion of spending power in the US alone. According to the 2019 report from McKinsey, Gen Z were accounted for 40% of global consumer by 2020. Therefore, Pandora will not only need to take care of their existing consumer base, but also boost their brand awareness among younger people. We also want to point out over here that about 81% of Pandora listeners are subscribed to their ad-supported service. That means the company is trying to make money from the subscription. Like Pandora, Spotify also have a large number of freemium users, but they're still able to capture the market because they have wide coverage across the globe. Unfortunately, Pandora is only operating within the United States.
These are the primary concerns users of Pandora Music face. Firstly, poor user interface and lack of features. The user interface is really hard to navigate and users cannot make a playlist on the free version. The premium model does not offer all that much more than the free version. The sound quality is still really low even for consumers paying $9.99 a month. Lack of Gen Z incentives. The student plan is not that attractive because it does not offer any bundling like the competitor's plan does. And the current marketing strategies are just not being targeted towards this generation. Lastly, lack of exclusive content. There are so many up and coming artists quickly gaining a large fan base on other platforms like YouTube, but they have no presence on Pandora.
We created a prototype of the homepage to showcase our recommendations for UI UX. Reminder that 20% of respondents mentioned poor design as a main factor that kept them away from Pandora. The current design, shown on the right, is difficult to navigate and lacks features such as the play button on the bottom bar, recently played playlists, top hits, etc. Our redesign proved successful as 74% preferred our redesign over Pandora's current design. Ultimately, this will help level the playing field between music streaming platforms.
As of right now, Pandora severely lacks in the audio quality segment. Their main competitors, Apple Music and Spotify, offer bit rates that are 33% higher. On the other hand, their lack of exposure in the foreign music market also limits their customer demographic. To combat this, they can diversify their music artists. For example, adding more Bollywood artists like Arjit Singh or Shreya Ghoshal can open their service to a new demographic. Moreover, providing exclusive content is just as important in order to provide subscribers with a unique content experience. And this is where signing deals with podcasters can come into play. An example could be Ben Shapiro or Barstool Sports. A way Pandora can differentiate themselves is by implementing a calendar that shows a timeline of when their favorite artists will drop new music. For example, if you're a Drake fan, you can turn notifications on for him, and when he drops an album or is in a feature, you would be the first person to know.
Presenting the new redefined student plan BCG has created for Pandora Music. We suggest they partner up with Netflix to provide students a bundle, which will give them access of Netflix's most basic plan, which gives them access to unlimited shows and movies on up to one device, as well as Pandora Music. That includes playlist making abilities, ad-free music, and unlimited skips. This deal will be beneficial for both parties as Pandora's users are mostly aged between 25 and 44, whereas 65% of 18 to 29-year-olds are subscribed to Netflix. Both companies can tap into each other's demographics and benefit from this deal. Sorry, this is our marketing overview for our client. Our main goal is to increase the brand awareness between Gen Z and millennial audiences especially. We will do so by increasing the marketing budget and then implementing this increased budget towards the following thing. Getting artists who are on Pandora to promote Pandora on their personal social media handles. Creating targeted ads that predict user behavior better than what they're currently doing. Getting younger influencers to promote Pandora on TikTok, streamlining brand image and palette across platforms and posts. And lastly, focusing advertising efforts on the Pandora Netflix bundle we just talked about.
Social media is the biggest expanding gateway to increase brand awareness to the younger audience, and Pandora is not capitalizing on this. Pandora's current brand and color palette are inconsistent throughout social media posts and platforms. For instance, they use a different profile picture than their app logo. They also have very low engagement on posts. We recommend more interactive and attractive posts that announce new song releases, story posts that ask polls such as which album with Drake is more goated, etc. Here are some examples of Instagram posts and advertisements that Pandora can use using the shown color palette and pop style graphic technique that target the younger generation and better match user preferences. The bottom graphic shows us effectively highlighting that Netflix Pandora bundle.
Pandora has leveraged its freemium service to grasp user data and maximize its advertising revenue, which accounted for around 70% of its total 2019 annual revenue. Pandora's remained stagnant for so long because they focused their efforts too much on generating advertising revenue, while their competitors found the key to growth in focusing on paid subscribers. The relationship between growth and paid subscribers is even seen in Pandora's financial statements, where the only area of consistent revenue growth has been through subscription revenue. There is a disconnect between the value Pandora makes for its consumers and the price it's charging. For the same price, Spotify offers you better audio quality, social features, and music discovery options like Discover Weekly. If the recommended changes to app functionality or content aren't taken, a lower price point should also be considered to at least grow the paid subscriber base.
This is a priority matrix we made for our recommendations. In the short run, we believe that Pandora's focus should be marketing and UI UX changes, as they require the least effort, but they can make the most impact. In the long run, Pandora should consider looking into expanding their exclusive contents and improve their music qualities to stay competitive. And with this, we constructed a 5-year plan. Next slide. We constructed a 5-year plan vision that we believe will help Pandora to become the #1 app for Gen Z and millennials, while having a very flexible plan structure that targets a wide range of different audience.
The following graphs show our 5-year vision for Pandora's net income. We anticipate a 2% annual growth rate in net income with our consultation. The second graph shows Pandora's projected revenue per user. If Pandora gains a larger paid subscriber base, it can expect to triple its revenue per user in 5 years.
Thank you for your time. That concludes our presentation. With the recommendations we proposed, Pandora can reach new heights and prosper like never before. Let us know if you have any questions. Thank you.
Thank you, Team 4. Now the judges have 7 minutes for any questions.
I've got some. I'll start off with some basic ones. On slide 3, I think, well, slide 3 after the presentation started, when you're doing the music streaming market share, it shows that Pandora has 2% market share. And then when looking at a couple slides down with the consumer breakdown, Pandora versus Spotify, it looks like Spotify has a lower user base than Pandora, at least from like years 2015 all the way through 2019, 2020-ish. Yep, that slide right there. So how does that market share versus this consumer breakdown here tie out?
So just to answer your question, the graph that is come from the consumer breakdown, that is like only the US market. And we're comparing to, you know, like the early market share that will represent like the global market share, because we understand Spotify does operate within like 79 countries, whereas Spotify is only operating within the United States. Thank you.
Got it. Okay. And then one more question regarding your primary concerns. I think a couple slides before this, the survey question was, why don't you use Pandora Music? The answer to the poor design and lack of user friendliness was only 20% versus any of the other three reasons. However, one of your primary concerns was the poor lack of design and lack of features. How does this 20% here make sense to focus on that versus the other three reasons to focus?
So this 20% is not like we didn't provide a multiple choice of each of these. This was actually things that people came up with and mentioned, right? Okay. So this is not like 20% of like what everyone thinks about this question. It's like more of like how people responded, like this is what people initially thought of. And so yeah, that's why.
What are you doing to address the other three things that people responded for?
So to target Never Heard of It, we presented a marketing overview plan that we are focusing on increasing the brand awareness, and we are improving the platform as a whole so that it has some differentiating aspects compared to Spotify, and that gives consumer a higher incentive to switch. And we also added a better playlist making ability in our model.
Yeah, so a lot of the reasons why they prefer Spotify and other platforms is because they aren't up to par with these other things. So that's why we suggested the UI UX change, because their UI UX is very much behind that. And also we suggested the timeline notification thing that can differentiate Pandora and give them a reason to prefer actually Pandora over Spotify. And in terms of the playlist making, we highlighted that and made it easier to do on the free version as well.
And just to go back to your first initial question, we mentioned that current user base is an older audience, 25 to 44, but now we will target Gen Z and millennials, and they tend to care a lot about the user interface. So that's also why we're targeting that and improving that.
Oh, thank you.
Do you guys have a sense of like what the dollar impact of each of these efforts will be? Like all the initiatives that you're talking about?
Right. Well, for marketing right now in 2020, marketing takes up around 13% of the total operating budget. Mm-hmm. And we are focused on marketing. So we expect in the next 5 years to increase that to about 18%. And the total for marketing expenses will have doubled, as well as the entire expenses. And for the exact numbers, right now, Pandora spends around $1 million a year on operating expenses. And with our added expenses, we expect it to go up to around 2.4 million.
Got it. And can you go one slide back, please? So that's for the marketing campaign. How about the UI UX change and improved music quality? Both of these are almost like R&D or product related for that matter.
So we mentioned that UI in the next slide that will triple our revenue per user, and the purpose of our UI UX change is that we think that will help us significantly in converting freemium users into paid users, and the Netflix bundle as well will help us with that. And because right now Pandora have about 90% of its users being freemium users, and only 10% of the users are subscribed. And for the same statistics, Spotify has about 60% freemium users and 40% subscribed. And currently, Spotify earns about 90% of its revenue from subscription, whereas Pandora earns about 80% of the revenue from ads and only 20% from subscription. And we really want to improve the share of subscribers versus total users, because we think subscription is a much reliable source of income than ad revenue.
Thank you.
Cool. And I'll close it off once again. Great presentation, by the way. I was looking at, we talked a lot about user acquisition and what that could look like. Do you envision that your strategies will be more of an attempt to convert current Spotify users onto your platform, or are you looking into more untapped or people who don't use streaming service already and are looking to use one?
There are a lot of people who have checked out multiple streaming services, but they aren't subscribed to a particular one and they aren't paying a particular one, and they keep trying different apps. Sometimes they listen music on YouTube, sometimes on Spotify, sometimes on Amazon Music. So there is a huge market that hasn't subscribed to a platform yet, and we're hoping to primarily tap into that, as well as get some customers that have subscribed to some other service.
Is it okay that I can jump in to answer more about that questions?
Go ahead.
So,
Go ahead.
So like our approach have like including to personalized strategy. So for the user base, we have like this customer, they're like around 81% that subscribe to that ad supported service. So with the improvement on UI UX design, we hope to create customer stickiness and convert them to more loyalty program, because 90% of user will continue to shop on the platform because of the great design. And also for the target expansion of the new market segments that we're talking about, Gen Z and millennials. So like the bundle plan with Netflix can help us to better compete with other existing customers, because of, like Spotify, they also have the student plan. They have incentive of like collaborating with other streaming business as well.
Cool. Awesome. Thank you. This is a great presentation. And I might be dating myself here, but I think I remember when Pandora was bigger than Spotify.
Thank you for your questions, judges.
Awesome. Thank you so much, team 4. That was great. We now have our last team for the day, Uber, team 6. You guys can get started.
Thank you, Sahana. I will be sharing screen. All right. Can you guys see my screen? Okay, perfect. All right, good morning, everyone, and good morning, judges. We are team 6, and for today's case, we'll be going over Uber's road to success. Here are our line of consultants for today. And for the agenda, like many other teams, we'll be diving into the problem statement, analyzing Uber's core issues, our possible solutions, and then our 5-year plan and timeline.
Judges, how many times have you and your friends found yourself in a late night drunk situation with no designated driver? What do you do in that situation? Well, your past self scheduled an Uber to pick your gang up. You're gonna feel nothing but relief later on when you climb into bed and safely know your friends are doing the same. Now, situations like this are what give Uber relevance, but despite that notoriety, the company has some issues that do need addressing. You see, Uber has historically dominated the ride-sharing market, seen when comparing the ride shares to go to the company with that of their biggest rival and the next most dominant firm, Lyft. Now, where does that lead us to today? Revenues from the ride-sharing service dropped 72% from the previous quarter in Q2 of 2020, and overall revenues dropped 35%. Gross bookings through Uber dropped 56%, whereas the amount of active monthly consumers on the platform dropped 47%. So the main issue we see here is the major loss in revenue that we can attribute to the decrease in the ride-sharing. But where does this problem leave us? Uber is in need of ways to maintain and expand revenue, which we think can be achieved through Uber to take steps into branching into other markets. For example, Uber Eats has been a relatively successful attempt at branching out into the food delivery market, and it would ultimately serve as Uber's lifeline during the pandemic. As you can see, Uber's 2020 fourth quarter delivery sales were up 115% from the first quarter numbers, before the impact of COVID, of course. But how can we both capitalize and expand on this strategy in order to push Uber into diverse markets while building onto their dominant position in the ride-sharing business?
Diving into Uber's core issues, we see that COVID-19 posed as the biggest threat to the ride-sharing market in 2020. Research from March of 2020, as you can see on the screen, shows that 40% of consumers aren't using ride-sharing services due to COVID precautions. 20% of consumers with no car are starting to look into investing into their own personal vehicle, and then 90% of consumers who own a car are relying on their own vehicle rather than rideshare. So you may be thinking, how can Uber possibly survive when the rideshare demand is so incredibly low? Well, we see this as an opportunity for Uber to actually shift gears and focus on expanding into new delivery market opportunities. And to justify this, in 2020, Uber Eats alone brought in $2.5 billion in revenue in gross bookings, a 179% increase from 2019. In quarter two of 2020, delivery services brought in 2.3 times more revenue than its mobility services. And the trend continues to rise, as in quarter one of 2021, delivery services were up by 166% in gross bookings, and mobility services were down by 38%. So undoubtedly, food delivery is where Uber has reigned supreme, but we see an even bigger vision for Uber. What if Uber could employ their services to solve an age-old issue, that issue being the last mile delivery? For those of you who are unfamiliar, last mile delivery refers to the very last step in a delivery process where your parcel is moved from a warehouse to your front door. Due to COVID, online shopping resulted in an additional $174 billion increase in e-commerce revenue. So the demand for faster, more convenient delivery times is higher than ever. Seeing that the same-day delivery market is also expected to reach $15.6 billion in 2024, we see that Uber can get a slice of this pie. But then we run into another issue, which is the driver shortage. At the start of 2021, the number of Uber drivers was down by 37.5%, and Lyft was down by 42.3%. And there are many external factors that Uber can't change, like COVID, public health, that have impacted this market. However, the main concerns of safety and compensation are ones that Uber can control. See, Uber drivers are expected to pay for their own car, pay for their own operating expenses, but they don't even have access to basic employment rights compared to standard full-time workers. Drivers also don't receive very many options for healthcare or proper sick pay policies. And although Uber has tried to offer benefits under the guise of Prop 22, they haven't really made big strides to keep their drivers loyal.
So the question remains, will rideshare return to the way it was once before, and how will this play into Uber's goal of profitability? There are still unknowns that remain due to uncertainty in a post-COVID world. Current estimates suggest business travel won't reach pre-pandemic levels until at least 2023 or 2024. If true, this would mean the demand for transportation will not fully recover for years to come. On the flip side, the forecast for rideshare in the middle depicts a slow but exponential growth once enough time passes. So what does this all mean for Uber's strategy? Because of the time it will take to recover, we should not treat the ride-sharing industry as a priority. Instead, to accomplish our mission and quickly raise revenue, we should focus on Uber's strength throughout the pandemic, delivery. And this leads into our first recommendation. Our solution focuses on same-day delivery in particular, and the potential for growth lying in the increased demand for convenient on-demand delivery. We are proposing a new line of business called Uber Shop. Uber Shop is a courier service that is not crowdsourced and would be kept separate from Uber Eats, in which it wouldn't directly interact with consumers through a platform. Uber Shop would instead cater to retailers, both large and small, who are needing last-mile delivery, with customers that would value 1 to 2 hour delivery window instead. And if any food delivery app is going to venture into the last mile delivery market, it would be Uber. Because on average, Uber Eats had the fastest delivery time and lowest cost. Once in this market, Uber Shop would directly compete with FedEx's same-day city shipping service, which typically gives a 2 to 4 hour window, not including pickup. Obviously, the delivery time for Uber Shop would be higher than the delivery time for Uber Eats, given the logistics needed to be factored in. But Uber already has an infrastructure of delivery drivers on standby, having the potential to challenge the market's competitor.
Our second recommendation is going into a new branch called Uber RX. You see, research shows that amongst those who solely rely on mail-order pharmaceutical drug delivery services for their medication, many suffer from disabilities and conditions which prevent them from being able to move around like most others. These people rely heavily on alternative means of getting their prescribed medicine. As 2016 showed, 6% of the estimated 4 billion prescriptions issued were delivered through mail. Were Uber to act as a middleman between those people and those pharmacies, this would no doubt benefit Uber, but it would benefit Uber both in terms of profits and in terms of Uber's contribution to social welfare. Now, 70% of pharmacies offer some sort of direct delivery. This has been shown to present a number of benefits. Independent pharmacies that implement delivery services see a rise of 6 to 8% in total revenues in the months following. But despite this, many pharmacies are hesitant in undertaking such a venture due to the huge risks and costs related to maintenance that it requires. For these firms, Uber would offer partnerships with the intention of handling the logistics of delivery in exchange for a percentage of the revenues. This would give pharmacies better access to patients that they would not have been able to reach otherwise, including those with low mobility or those in remote areas. Pharmacies have a reason to value a partnership with Uber, and with Uber's current structure, this will come at little cost. Much like Uber drivers deliver food at the touch of a button, pharmacies could easily request a driver to pick up a prescription for delivery. Costs would mainly come from setting up operations and maintaining a platform for establishing delivery transactions. This will require Uber to invest in providing quality software engineers a means of payment. But developing the Uber RX product segment itself would cost about $110,000. However, all these costs would be heavily outweighed by the increase in revenue required from taking about 10% of the payment going towards pharmacies. The average delivery pharmacy earns about $280,000 in increase to revenue from implementing delivery services. And with this in mind, Uber's venture into the prescription drug delivery market would no doubt inspire reliable and sustainable growth in revenue for the future.
Our third recommendation is to provide better driver benefits through the Uber Pro loyalty program. On the left-hand side, you can see the current Uber Pro rewards, while on the right-hand side consists of the new additional benefits that we will implement for each driver level. For example, Blue drivers get 10% 401k matching plan. Gold drivers receive free tickets to certain events. Platinum drivers get 50% tuition assistance, and Diamond level drivers will get better assistance to financing a new vehicle, as well as Uber stock for their loyalty. In our 5-year action plan, in years 1 and 2, we'll be focusing on the implementation of Uber Shop and Uber RX to capitalize on the quarantine landscape. In years 3 and 4, we will take advantage of, due to taking advantage of the loosening of COVID, we invest heavily into Uber Pro loyalty program while maintaining the new branches. In years 5 and above, post-COVID-19, we focus on sustainability in the new markets we ventured in while maintaining employee relationships. After recommendations take into effect, we hope to see a steady rise of at least 5 to 10% revenue growth year after year for Uber. With this plan implemented, Uber can recover from the downturn in rideshare and come out stronger than ever in pursuing profitability. Thank you for hearing our case, and let us know if you have any questions.
Thank you, Team Uber. Judges, you now have 7 minutes.
Well, I can start this one off this time. Great job. So I have a question. We talked about the last mile delivery, like having Uber drivers do that. Do you envision that to be, Uber drivers sort of waiting to pick up someone, they can accept the task to go do this last mile delivery, or is it a completely different service? If you're doing packages for last mile delivery, that's all I'm doing. I'm not going to be transporting people.
Well, it would be like that. So currently, Uber drivers can both do Uber Eats and rideshare. And we kind of envision it would be the same thing for Uber Shop, and that would be another delivery option that they could undertake. So it'd just be whoever's available at the moment. Like when you order a rideshare, you wait for a driver to come, but for Uber Shop, it would be the same thing. They would have multiple duties, and this is just kind of be another avenue for making revenue and another responsibility for Uber drivers to undertake as well.
Yeah, and I guess to follow up on that, do you foresee any challenges by having having these people who Uber was originally made to transport people from point A to point B, and the Uber driver doesn't have to get out of the car, but now you sort of have to train them on okay, you have to sign this and you have to get this documentation before you can make a delivery, and what happens if you have a package in your car and there's an Uber ride? Do they have to share the seat with the package now, or things like that? So any considerations for that type of training, or how that would work out? Is it feasible?
I like to incur on that matter. As I myself am an Uber driver, we have the flexibility to select our own rides, and so. For example, through Uber Eats, we can do at least 1 or 2 deliveries at the same time if it's from the same restaurant. Same thing with Uber Shop. We can go to the same retail. We'll show in our through our cell phones, right? Who are we picking up, and we can do multiple ones at the same time. So it's concentrate on that, and it depends on the driver. It's oh, after this, do I want to do more Uber Shop, or I can just keep my flexibility, whether it's Uber Eats and Uber.
Okay, cool. Thank you.
Now, if I can also add on that, I know we've had this question before, but if we were to pick a company to actually compete against, it would be kind of similar to Instacart, whereas it's more so not really an issue. Also, it's more so not really an issue of sharing your ride with a package. I've done Amazon groceries, so ordered groceries to my house, and I go downstairs, and the guy's packed all my groceries in the back of his little sedan, and not just mine, but somebody else's groceries. He goes by, verifies which packages go to which address, and then he'll bring them all to the front door. And much like Uber Eats we've already seen the implementation of where drivers have to get out and deliver food directly to your apartment. So Uber Eats and the profit margins that we've kind of shown you today, that still seen as very profitable, even given that challenge that Uber drivers have. So that challenge, I don't really see as being really inhibitive of our profitability in Uber Shop.
Cool.
Thank you for the question.
Thank you.
So guys, can you go back to the slide with the 5-year, which initiative you're doing at what time? So help me understand this. 21, they are still down with everything. Their primary concern should be to save on the cost. You're saying let's put more investment into to pay more money with these Uber RX. That's the reward thing, right? The driver reward.
I'm sorry, I couldn't really hear you. Can you speak my Uber?
Is this better now?
Yes, it is.
Awesome. I'm saying this Uber RX is the reward, right?
Uber Pro is the reward program, which would be implemented after the
Yeah.
additional revenue stream of Uber RX.
The point is, like, you mentioned that there is already like drivers and the revenues are down, and you're saying you'll enter into new markets.
Yes. Well,
top. So how would you manage that in a very quick turnaround way?
Yeah, if I can handle this one. See, this is kind of how we approach this plan, because right now Uber is mostly profitable in doing their delivery services, whereas we don't have to have direct interaction with people, where people are waiting at their home for things. So the little cost that comes with the UberX and Uber Shop branches, you see, these are already things that can just be added on. The only cost that would really come from that would be the development of the software to actually connect Uber drivers with the places of business. Now, the cost related to drivers, we don't really see a big cost there at all, because we already have mechanisms that are similar, like Uber Eats. So we have the same drivers who are going to be out in the same cars. We don't have to provide cars. We don't have to do anything like that. And the costs that we see don't really level up to any inhibition in revenue. But the only main cost that we have will be in the Uber Pro section of our plan, and we plan to actually implement that plan or focus on that plan probably in years 3 to 4 after we've gotten a few years of the UberX and Uber Shop, which are our low-cost ventures, and we've accumulated revenue from those ventures that we can use that revenue to kind of direct and accumulate those funds into new ventures. That's kind of our plan and how we see it going.
Good. And the Uber Pro rewards for driver, is that just kind of like based on the time that a driver has spent with Uber, or is there something else that you have in mind?
So for that, it depends on the driver itself, because Uber has very flexibility on their independent contractors. So a driver can do this part-time or even full-time. And so right now it's based on a point system, and they have to participate or take as many rides to get those levels. So when you first start off as a driver, you start off at the blue level. And so once you reach 800 points, you go to 8 gold and additional 800 platinum. And then once you reach 3,600 points for that quarter, you reach diamond. And diamond is like the very top level one. And so as you go forward, it's based on the rides and the points you accumulate.
So all you're recommending is to change the benefits that you give to the drivers rather than.
That is correct. Yes.
Yes.
So right now, yeah.
Sorry, I was going to say, if I can add on that, we're kind of focused on increasing benefits to drivers, because that will increase employee satisfaction, which is kind of a long-term. I know it seems like a cost, but it's a long-term benefit in the sense that we're trying to strengthen our employee relationship, given that we're going to be implementing this plan in years 3 to 5. As we develop a new, like, how workers kind of cycle in and out of the company, hopefully we'll start to accumulate employees who are more satisfied and more happy to be with Uber, and therefore that will benefit our long-term profits in a sense where they'll be more productive and things will be more efficient and they'll run more optimally. That's kind of the goal.
Thank you, team.
Awesome. Thank you, Team Uber. Yeah, Wendy, you can share screen. So now we have another break for about 30 minutes or so, where the judges will be discussing the result or all of the participants, and we'll be back with the results in another. Okay, I think almost everyone's back. All right. Okay, awesome. Welcome back, everyone. Thank you so much for your patience. The judges are now ready with their results. And first of all, we want to thank you all for participating today. We really appreciate all of your hard work. And also, I just want to say that this is our 4th virtual KISS competition. And we are just super proud of all of our members for putting in their hard work throughout the quarter. And yeah, just really excited to see the results right now. So from here, I'll be giving it away to the judges. They will be sharing individual feedback to for all the teams first, after which they will be revealing the winners. So yeah.
Cool. Thank you, Sahana. And before we actually jump into individualized feedback, we're going to be giving overall feedback, things that we can all learn from today. And I guess before I even start that, just first of all, great job, everyone. Super impressive work. So starting off, one of the first pieces of overall feedback we have for all the teams is to make a compelling story, have a good storyline going into your presentation. The biggest difficulty is to convert the analysis into a compelling story. And there's different ways to do this. A good story has to be logical. So how you organize the sequence of your slides should be, in a logical thread, or it should also be, and it should also be compelling. It explores the topic rather than just walking through, the analyses. And it also has to be audience appropriate. So there's different methods in which you can break this down, whether it be a pyramid structure where you have your main problem and you go into have this top-down structure, or there's different ways you can organize it. So I really encourage you all next time when you do something like this to take a step back and maybe start with the storyline. One way that I like to do this back when I did case competitions was I would take pieces of paper, like white paper, and I just tape it onto a wall or use a whiteboard and just draw out the initial storyline of how you want your slides to flow, even without the content. See if it makes logical sense. Now passing on to Po, I believe.
Yeah, agreed. I think one thing I did learn during my time in college versus something I see almost on every deck right now is an executive summary. That's on the top of every slide. So thanks for that feedback. Something else I think in terms of overall feedback is to recognize the problem and then prioritize the solutions. So not only do you recommend like 3 to 5 to 10 number of things, but how do you value those recommendations? You should prioritize what should be done first, second, and third, and provide meaningful insights into each of those recommendations. What is the cost of doing this recommendation? What is the benefit of doing this recommendation? And what is the timeline for implementing the recommendation? Those are all important things for clients to consider when assessing things like impact to effort to investment. Now I'll pass it off to Abhay to tie it up.
So, and I think the last thing that you guys should all think about, and this is like any consultant will probably be doing in any such like case study, is one is research, just figuring out what the underlying reasons is. The second is simulation, which is like you provide some solutions, but then what will it look like, be it on a timeline perspective or on an overall impact perspective. And the third is the follow-up, which I think like is the most ignored part of things. But like once you're able to have some sort of revenue recognition recommendation, how do you actually follow up to track if that is happening or not? And within the research and the simulation part, it needs to be both qualitative as well as quantitative. So like once we are doing any sort of research, we'll actually go and talk to the competitors. We'll actually go and benchmark our expenses, our profits against the competitors. We'll also be doing their financial analysis, which is an inside research within the company. And similarly for the cost side as well, we'll try and figure out like, do we need these many people or not? And all of that will tie up into what Po and Alec was saying, which is, well, these are all the problems that are there. And we were able to put our research numbers as well as some quotes from customers, competitor, whatever, to tie it all up together and say, okay, these are the perfect things to be focused upon. These are the great solutions. And within these solutions, X, Y, and Z is what needs to be done in a specific order in the timeline that is required. So with that, I think we'll move to feedback for each team, and I can start there. So, and we'll go in the order that it was presented. So we'll start with Intel. So Intel, guys, and before I even go there, again, just reiterating, all the teams, really good work, really hard work. Whatever we are saying is just to help you guys make it one step go from good to great kind of situation. And we actually had a lot of conversation around like who should be the winner, but honestly, it was like so close that all of you just did an amazing job making our life difficult, but we had to do something there. So I'll start with Intel. I would say we definitely liked the presentation design. It was very simple. It was very clean, and we really liked it. We also like that there was a lot of underlying research which has gone into the overall study, and the specific examples of like Mobileye or Zscalers were really good. What we would encourage you to do is to basically have some sort of prioritization framework to realize what the solution set is. And I guess like I get it that there was some sort of thing, but something like, and I'll go from recognizing the problem in terms of prioritization versus the solution. On the problem front, you can look at versus importance, which is a framework, be it for your personal or your professional side. And in terms, you should definitely look at your impact, your versus the associated with it. So that is for Intel. For Quiznos, we really like the clean structure that it was presented, and also that there was a focus on both the top line as well as the bottom line. The presentation was well organized and thoughtful, and it was focusing on all three aspects, which is the marketing, the product, as well as the go-to-market strategy. We also like that there was a prioritization within the solutions, and it was tied up from the beginning to the end. The only thing that I would say is that it's very important to tie out your numbers in terms of like what you're seeing, but also in terms of like your costs and your savings and all those kind of things should make sense. And if you don't have those numbers, you should have some sort of basis on the assumption there, which is like if in general situation, let's say that they were having 50% loss, then that can be converted into some sort of numbers for their cost sides in the future as well. So I think just tying up the numbers is the major feedback there. And I think, Po, you're going for the others?
Yep. Next up was GameStop. Bold choice with bold and relevant choice with these times. But I do like that you picked this company and decided to go with really looking into how to improve it. I think one great solution was you proved the need for gaming lounges. You did a great job of saying that it works, and that you provided concrete examples of where it has worked and how you can use your brand name and the diverse amount of locations you have to really double down on that. And you guys also both, everyone had a good Q&A presence. You were all pretty well done in your research and you were very prepared for those answers that came up. I think there were some financial questions that were answered, that were not directly in the deck, but you were all prepared to talk to those. I think the solutions could be a little bit more complete. As I mentioned, you guys talked a lot about the gaming lounges, but a little bit more breakdown as to how you would use that $500 million on cash to invest into these gaming lounges. Where would you start? Which of these locations would you start at? And why are you choosing those locations for the pilot? And then what does the roadmap look like to implement that? And what does the projected revenues look like for rolling out the gaming lounges? In terms of the hardware sales, I think that's a little contradictory to where GameStop is trying to go in terms of trying to be more digitally present. So it was a bold recommendation, and I did enjoy Chance's answer to a base question when Abe asked why you would bring in people to into the brick and mortar stores rather than fixing the issue with selling things online. But again, great answer to say let's bring them in, increase our brick and mortar store presence, and therefore we can upsell them with other products as well as get them more interested in the gaming lounges. So I think that was a pretty good answer. So well done overall on that. AMD, you all had a very clean presentation. Your financials were good. They were very comprehensive. I will give you the benefit of the doubt and assume that they're accurate too. I know, and I think we didn't really get into too much of the details of the financials there, but everything you guys had in terms of the presentation was very good. One thing area to improve on would be the details in your solutions. You gave an overall category and qualitative solutions, right? You had a bunch of ideas of solutions and way to solve the problem. But I would have liked to see each of you dive a little bit deeper into those solutions. So a little bit more rigor towards recognizing the main challenges that you're tackling. You talk about debt being a problem as one of your top 3 challenges at the beginning of the slides. But then when pressed about it, debt was not a current problem. It's more of a thing to consider as you go forward. You did mention that debt was low, which sort of is a problem, but more so because you should increase your debt going forward to a more healthy amount. And we can talk more on that offline as well if you have any questions as to why increasing debt is good. But those are my feedback for both GameStop and AMD.
Cool, thank you, Po. And moving on to the next team, which is Pandora. Some of the pros, the positives, is we really enjoyed looking at the survey. So that showed that you guys went out of your way to conduct some research yourself, and that led to you creating a more comprehensive solution based on what your survey told us, right? And having that comprehensive solution was also another positive, and having that work plan to move forward and having certain frameworks to support decisions. We also really enjoyed the priority matrix, that having like ranking your problems in effort and impact. Yeah, in terms of things to improve on for next time, we would have liked to see a more better flow in storyline. You have your priority matrix maybe in the beginning, so you can tell us about which problems you're going to double down on before you actually go into it. And maybe we can work on some of the where each slide goes, because at times you had an Instagram post, then suddenly you went to a partnership, then back to revenue, then back to IG again. So maybe take a look at the bigger picture and see how we can, from a broader perspective, are these categories, these buckets making sense in the order they're in right now? But overall, great job. Moving on to the final group is, I believe, Uber. So for Uber, one of the things that immediately caught our attention was the stage presence. Every single speaker was so strong, especially Eli right off the bat. We're engaged, right? And everyone was able to continue that energy. So for all the teams looking at like speaking, it's super underrated, but speaking is how you deliver what you have on your screen in your mind to the people. So you want to keep that energy up. So that was really well done. Presentation was also well done, very clean financials and graphics. And The solutions are great because we got to see the key challenges on how to grow revenue, and we address the bottleneck inside the solution. Things to improve on next time. Maybe we can dive deeper into projections. So something else also we can do is opportunity sizing. So we talked about starting like the business lines, but maybe we can talk about how much of the market we plan to capture, right? What's the total market? You know, the things we talked about, last mile delivery and prescription delivery, are things that are growing and maybe not too, it's not too widely spread right now. And maybe if there are numbers, maybe there isn't, but if there's numbers, you can say like, this is the total market, addressable market. And out of that, you know, we plan to capture X% of it. And with that, this is a feasible amount. We also thought that starting 2 business lines in years 1 and 2 was a little maybe too ambitious. So it's a little bit about feasibility too. If you're talking to a company, like maybe between those 2, which one's going to be more important? That might be some question you have to answer in the future. But overall, great job to these 2 teams. Great job to everyone. I guess now the question is, are we ready to figure out our top 3? Can I get a thumbs up maybe from everyone? Yeah. I know it's Saturday. We all have things to do after this. But if we're ready to go, Sahana, do you have a thumbs up to move on to our announcement?
Yeah.
Cool. All right. Awesome. And thank you everyone for thanking the judges, but we should be thanking you. All right. Now, can I get a virtual drum roll, please? In 3rd place for our EBSA consulting case competition. Actually, before I announce 3rd place, I have a question for Jay. Hey, Jay, should I get a veggie guacamole or a spicy Monterey sub for lunch from Quiznos?
I think a spicy Monterey, if you're a spicy guy. I love that sandwich.
Awesome. Well, because J Credit Consulting, you guys are a 3rd place finisher. Congrats, Quiznos.
Woo, congratulations.
Right, thank you.
Thank you.
Congratulations, Team 3. I'm sorry,
Perfect.
Team 5. Quiznos.
Great job. Great job. And, you know, it's the underdog that always wins. So hopefully I'll be seeing Quiznos coming back to life.
Cool. Thanks, Alec. 2nd place, got drum roll. Quiet as well with everyone muted. Is Uber.
Let's go. Congratulations, Uber.
Congratulations, team.
Something to mention, actually, Uber had just 4 members on their team, so I think that is amazing.
Absolutely. And I think as somebody from McKinsey, as I'm announcing the one, it's a competitive name there, which is BCG, the Best Consulting Group, is our first one with Pandora.
Yay!
Well done, team. Congratulations.
Good job, team.
Congratulations.
Well done, guys. Congrats, everybody. And like, as I said earlier as well, it was really difficult. That's why we took 45 minutes.
Yeah, we were debating, we were talking, yeah, going back, and you know, everyone did such a great job. This is great work, and especially for those looking to get into consulting, you know, you guys are taking those steps in undergrad to approach a great career in that.
Thank you so much, judges, for the results. Clay, you can move to the next slide. So first of all, yeah, thank you once again, judges. We really appreciate you guys coming out today. We know that this is a large time commitment, so this is a big deal. And all your feedback has been super insightful and some very challenging questions. I think all our teams learned a lot today. So yeah, thank you so much for coming out today. And I will be sharing the judges' LinkedIn's if you guys would like to connect with them later, and we will be sharing this later as well, but here they are. And yeah, thank you so much. And secondly, our virtual certificates and prizes will be sent to the team mentors, and you guys can share that with your team members later. And just another reminder that we do have our last general meeting on Tuesday. And Ethan's not here for this, but we do want to touch upon membership requirements. And if you have not satisfied that yet, you might want to get in contact with Ethan and get that cleared up. And another reminder about like our spring formal, which is the following Saturday. And it is again an open event. It will be held from 7 p.m. to 8 p.m. And yeah, I also did want to mention that there were actually 14 teams trying out. So we had a preliminary round earlier this week. So these were the top 6 teams that made it. So coming here is a really, really big deal. It has been super competitive. So yeah, congratulations once again to all the teams. And yeah, thank you so much to everyone who came out here today. Yeah, you can go to the next slide, Chloe. It's just a thank you slide, but thank you so much for coming out today.
Yeah, thank you guys so much for coming. Even those who are not in EBSA, we hope to see you guys in EBSA next quarter, maybe. And thank you again to the judges for staying for the entire period.
Somebody asked for a photo. I think that's a good thing.
Don't leave yet. Chloe, you can stop sharing.
Yes, we are planning on taking a picture, so just like I'm going to stop.